Hey, welcome back to Two Super Guys Trade Stocks. I'm Dylan.
And I'm Vinny.
And this is going to be kind of a cool video. So we're going to take a look at TLT, do a little TLT update, but also the overweight PE ratio of the market, the recession risk, and the thing that's in the news right now, the inverted yield curve. So we're going to take a look at multiple things. We're just going to get right into it because it's kind of complicated. But when we do these TLT videos, just for the record, there's like GovT, I think, ZROS, EDV. There's other things that work, guys. I'm just doing TLT. If you think any of those are going to do well, then this evidence works for all of those. They're all similar, not the same.
Yeah.
To be clear,
Investment thesis is the same. The vehicle you choose is your own choice.
it's just different vehicle.
Yeah.
We actually did a video on those, but so this is just good old TLT. It's just chugging away, nothing special. However, do you know what the inverted yield curve is, Vinny?
Yeah, it's when the yield on like short-term bonds is higher than the long-term one, which shouldn't make sense, right? Money should theoretically be more expensive over longer term horizons.
Exactly. I'm going to minimize myself here. So essentially what's happening now, if you look up what does an inverted yield curve on Google mean right now, there's going to be a thing that'll say, hey, it can predict recessions. It used to be able to predict recessions. Now it has a lower chance of predicting recessions, which is kind of interesting. So the typical one is usually the 10-year and 2-year. You can do both. So the gray area here, can you see my mouse?
No.
There you go.
Well, now
So
I can. Yeah.
recession.
Okay.
So this red line is where we have the inverted yield curve. So each
Yeah,
time
that's
it happened,
good.
recession. And then we have this long ass one where we've been under here for a long time, no recession. All right?
Well, if you
Interesting.
notice, the gray bars are usually after the yield curve is uninverted.
Yes, that is
Yeah.
correct. I'm very glad you
And
just said that because
we're
look at
approaching a
what's
record,
happening.
right? Or something like that.
We already beat the record.
Oh, okay.
Yeah. But I'm glad that you mentioned that it usually, other than the first two, actually, I can just go back to that and show you. Usually it'll recover. And then we have the recession. So recover, not really recover, not really recover. All right?
Okay.
Now, so we have since early July 2022, we beat the 624 days inversion in 1978 for the longest one since then. And as Vinny pointed out, it looks like we're actually about to cross back to normal.
You're
Interesting.
calling for the longest yield inversion in history to come to an end soon, is what you're thinking is about to happen.
To be fair, that's not like a hard prediction because you could just say, I think the longest inverted treasury yield curve is going to end soon. Because soon is
Okay.
relative, so it'll definitely end in the next 50 years. 100%.
Yeah,
I,
sometime in our life.
I'm
Perfect.
I'm willing to bet your life that in the next 50 years it's over.
Yeah, me too.
Pretty confident.
Yeah.
So yeah, pretty interesting, right? Now, why are we talking about inverted yield curves? We're going to get there. Now, as we have pointed out, the entire market is being held up by like 7 stocks, the Magnificent Seven. Really not
Yeah.
Tesla. Tesla's actually had it on a tear, but when you look at yearly gains, it's not even close. But those stocks, 33% of the SPY, 43% of the Qs. Okay. Now I want to show you something. All right. This is the average PE ratio of the SPY. Again, gray areas are, here, let me minimize you just a tiny bit. Gray areas are recessions. Okay. So you have your recessions. We can see the average PE ratio. Now, of those super, super large stocks, I put in up here 2024 through 2020, the average PE ratio. Okay. So
Okay.
2021 was a little bit crazy, but we're usually mid to low 20s. Okay.
Hmm.
For like the last 4 years. Usually we're below that, but we're pretty high right now. Actually, in history, quite high, but pretty high relatively recently. Now look at, you have NVDA 76, Tesla 73, even Apple's hefty 35, 36, Microsoft 40, Amazon 40, Google and Meta actually in high 20s. They're still high, but relatively valued to the rest of the Mag 7. They're actually doing pretty
Yeah.
well. Now, when you have these stocks that are carrying almost the entire market, which I'm going to show you how they're doing that, and they're also that overvalued, and we have an inverted yield curve. Interesting. Let's
Okay.
just see what happens. Let's just see what happens here. So
Mm.
this is gross. This doesn't really have anything to do with what I was just saying. It does a little bit, but NVIDIA is responsible for more than 1/3 of the gains in the SP 500 this year. Just one
That's
company.
totally cool. Yeah, that makes great sense. I love it.
It's. I mean, they're an incredible company. I would love to own them at a cheaper price. I'm not shitting on
Yeah.
NVIDIA. I would love to have a lot of my portfolio in them, just not at this price. It's just too much. So here's why this is kind of crazy. 38% of the SP 500 have actually had negative returns in the first half of 2024. Not zero, negative. And yet the SPY is hitting record highs,
Yeah.
and you have almost a record PE ratio. It's crazy. That does not make any sense.
Okay.
All right?
I mean, let's be fair. Those businesses are highly valued because they
Mm-hmm.
are fantastic businesses. All right. They're called magnificent
6 of the
for a
7,
reason.
I agree.
Okay.
Never gonna get shit for that. So this is I had a couple comments saying from multiple people being like bonds during recessions don't actually go up. It's a myth. I don't. It's very easily searchable, but I figured I just put it right here, whatever. So this is the SP 500 to total bond index. So it's a ratio, all right. So the higher the ratio above this one here, the higher stocks are compared to bonds. So you actually want it to be low. So this is 2000, and then we have the bubble. It shoots down, meaning bonds shot up. Okay? Same thing, 2000,
Okay.
boom. Same thing, 1987. All right?
So bonds either shot up or were lost less value, considerably less value than stocks or equities did. That's
To
really
be
what that
fair, that is another conclusion you could draw. I'm also just going to show you the graph.
means. Okay.
So no. But
Yeah.
that's fair. But this is just, if you wanted to read this, it's just kind of explaining how the bond index works. Essentially, as they go down, the number gets lower. So here's your price comparison for TLT to SPY, not bonds, just TLT. So you can see during this crisis, TLT shot up by a fairly large percentage, and then the SPY went down by a fairly large percentage. Okay.
And that's 2008 financial crisis.
Yep,
Correct.
right there. Yeah, you can look at the graph. And also .com bubble. It's just straight up. And then you also have, as this is tanking, going down at the exact same time, TLT, boom, went up, hit 180 actually, which is insane for a bond.
Yeah.
But it is a direct inverse relationship. I'm not really sure why people are saying it's not. This is also during a cutting phase, because we are entering a cutting phase with the Fed on what usually happens. So during it happening, bonds historically have the best returns over stocks and real estate. Okay? And then you have quarter after where it then gets outpaced. But during it happening, bonds are the key. Bonds are the winner. All right. Now let's go back to this recession probability here. Okay. I have a little bit of a problem. I'm going to play devil's advocate on myself here because these recession probabilities are absurd. Okay. If you use the Treasury spread 10-year bond over 3-year bill, you can see they do spike up each time there's a recession. And currently, the probability is 55% of a recession. So, I mean, I get it. It's very high. It looks like we're definitely going to have a recession. But just to play devil's advocate on myself, here's using that formula, the recession percentage chances by month. So in the red box, these are months that we have already passed, or I guess we're in July.
Yeah.
The recession risk has been over 50% that entire time. It did not happen. All right. And it is projected through June as being above 50%, except for October, which is odd because that's usually when market crashes happen. That went through me. I can't figure that one out. Yeah. But
getting the rate cut in September already, so that's what they're basing that on.
Yeah, but I mean, just historically, it seems I would throw that one up there. I guess I don't know, but you can see through 2021 all the way through 2023. It is a very very low risk. They were correct. They were wrong in this one. We will see what happens, but for the TLT play, the best scenario. Not that I'm hoping for a recession. I, this is a weird thing to hope for, but rate cuts and a recession, bonds are going to kill it. It's not even going to be close. It's going to be awesome. I do think that is going to happen just because the other socioeconomic things are happening with unemployment in particular. Then rate cuts, no recession, stocks will probably outperform. I think the market is very overvalued right now. I got to be honest. There's a lot of analysts calling for an 18-month bull market from here on. I don't see what's possible, but I also can't believe we're this high. So I could 100% be wrong.
Yeah. Okay. A few thoughts. One, you've definitely seen an interesting switch with we talked about rotation a little bit, and that kind of equities indication you had there. I didn't know if it parsed out like total U.S. stock market or was just tracking S&P 500. But small cap stocks historically do better during those recessionary time periods, which is why all of a sudden you saw CPI go negative, and now we're maybe looking at rate cuts. That the S&P 500 tanked on Thursday, but you saw the Russell 2000 index have a 3% positive day. I want to say the delta between the two returns for the indices was either the largest or second largest in history of the stock market on Thursday this week.
So
And then Friday, they added another 1% to Russell 2000.
Was your question, was the negative return S&P 500 stocks or all stocks?
Yes.
It was S&P 500.
So I would like to see what that data looks like comparing bonds to small cap indexes. Personally,
yeah, it was S&P 500. That's true.
And, certainly if we're looking at recession, we're looking at probably a consumer-driven recession, right? Like everyone's complaining about money right now, and I'm starting to, anecdotally experience a little bit in personal life. Like last night, I went to dinner at my favorite local Irish pub, and we got there at 6:00 p.m. on a Friday, and it used to be parking lots would be packed. You couldn't get a table, and we walked right in, and there were multiple empty tables last night. Like I think people are pulling back in discretionary spending, particularly for things like that, and you're starting to see the fruition coming that consumer spending may actually start to take a downturn as people tighten their pockets or their belts a little bit more.
So I want to show this one thing because you hit it on the head. I do think we will not have a recession. Once again, I don't know what I'm talking about, guys. I'm just an idiot on the internet.
See the channel name.
I don't think it's going to happen until this inverted yield curve ends. And that could definitely take a while. I think that there's going to be a couple of rate cuts that need to happen. And then I think we did a video one time on the bottom of the market after the first pivot. And I believe it was like 180 days.
Yeah, that was, I think, the average duration, but it was a pretty wide dispersion where like half of the market bottoms were before the cut, half were after the cut.
Yeah.
It wasn't really like a useful metric. But I want to say that was probably like the mean time between the rate cut to the first rate cut and the market bottom. But that doesn't necessarily, I don't even know if when they said market bottom, if they were talking about large cap versus small cap or total stock market index. I don't know.
Honestly, the probably best indicator of this would be if Apple, Microsoft, or NVDA have a terrible quarter. Then it's probably over because all that money is going to rotate out because they're historically so high. It's crazy. If like Apple and Microsoft specifically, I didn't put this slide in because Tesla and Amazon kind of ruined it. But because their PE ratios, Tesla had like 1,000 2020 because there's a weird earnings thing. It just ruined the graph.
Yeah.
But Microsoft and Apple are historically almost more highest PE ratio, not highest, but towards the higher end than they have been in a decade.
I believe it. I mean, and Apple is barely growing at all anymore revenue wise. Like, they're eking out single digit gains. So to pay high 30s PE for a company that's got barely any growth at all is extremely questionable. I'd rather pay 75 PE for a company that's growing like gangbusters like NVIDIA at that point.
Yeah, that's fair. All right, guys, let us know what you think.
Catch you next one.